It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. All right, Managing Your Financial Future. Hello. Welcome back. I'm told, is this episode 100?
I haven't counted them up, but I've been told as well that this is the magic 100.
This is magic number, episode number 100. I'm going to have to verify here on my little count thing. But yeah, how about that? It is episode 100 of Managing Your Financial Future.
I don't remember episode 1.
I was just, I don't either. I looked back.
I'd like to go back and listen to it just for old time's sake.
Just see how we did. I'm Johnny Dean, your podcast host. This is Professor Rick Plum, the advisor half of the duo here. 100 episodes, and I thought back to all the TV shows we've done and all the radio shows, which it's got to be
20
over
plus years,
10,000 of them. But 100 is a pretty good milestone. I said last time that we were going to do something special, and I have nothing. I don't.
Well, everything we talk about is special, but I mean, mostly we're talking about how to get by in the craziness that is this world that we are living in from a financial standpoint. And how do we rely on something that is, on a day-to-day basis, very unreliable?
It's scary to people. It's scary, especially when you have markets doing what markets are doing. And I don't know when people are listening to this. I never do. But as of this recording, actually as of last Friday, which was the 10th, right, of June, according to BTN research, S&P down 17.6 year to date.
Might be past 20 today.
It's that bad, huh?
It's an ugly Monday.
Oh man.
So far.
Yeah, you never know. And again, we're looking at this stuff day to day, and we shouldn't be doing that. We do it just purely out of amusement. The last time that the index suffered a double-digit loss after a year was 2008, which was 37% that year. Now, I was told, Professor Plum, that the stock market does 7.5% on average per year.
Depending on how long of a time frame you're looking at, 10 years, 20 years, 25 years, you're probably closer to 10% on average year in, year out. Now, the key there is that year in, year out terminology. If you go from point A to point B and then calculate what the return is, over the past 25 years, it's been closer to 10%.
Yes.
I don't know if there's been a specific single year where it was actually the average number. It's always either higher or lower.
Well, I want to talk about that because the question, there are two parts of the question, and it has to do with, number one, how much can I earn in any given year in my portfolio, in the stock portion of my portfolio, and number two, how much can I take out? And that's the question people have, is how much can I take out of my portfolio without having it run out of money? And that question is what keeps financial planners busy and it keeps you guys doing the research that you have to do. To the first part of the question, you saw this, you brought this to my attention. Again, BTN research, by the numbers. This says the S&P 500 has averaged 9.8% per year. Now, that's total return over the 25 years ending 12/31 of 2021, which happened to be a pretty high.
It was close to the high, depending upon what index you're looking at.
Right, S&P. So 9.8% per year. So they conclude a lump sum of $865,656 in a pre-tax account will sustain a 20-year payout. 20-year payout of $100,000 per year, Professor Plum.
Yeah, well, I like, by the numbers, BTN research. This particular statement is ridiculous. It is stupid on the face. For one thing, it's saying, it's like equating it to a retirement income. So they're saying if I had $865,565 today, I can take $100,000 a year out with fairly high certainty because that's what it's averaged over the last 25 years. But the first thing that I noticed was I don't get any money for an entire year. I don't get that $100,000 until the end of the first year. And I have to hit 9.8% return each and every single year. Not higher. I'm not worried about the higher. I'm worried about what about those years like the year we're in right now, where you're down 15, 20 or more percent. What about 2008, 2009 when it was down 37%? And you're trying to take money out of that. That statistic is one of the most misleading, misguided, stupid things, and it makes people think that they can do this without any risk.
Boy, you said it. Thanks for listening, folks. That's our podcast. Really, that is what we're talking about here, which has to do with how much you can take out. And this is the problem, as you said. This assumes assuming the funds continue to earn 9.8% annually.
Now, I flipped it around also because I don't want to, if I'm retiring today, I don't want to go a year without taking a distribution. I don't want to go a year without having any money. I'd kind of like to eat and pay my bills between now and then.
Mm-hmm.
So what if I took the $100,000 out now and then lived off of it for the first year in a bank? How much would that $856,000 I'd have to earn 11.3%. Just changing one little aspect of that. I want my money now. At least the distribution.
My money now.
So 11.3 is unrealistic. 9.8 is unrealistic. Now, if I'm setting it and forgetting it for 25 years, yeah, I can pretty much feel that I'm somewhere close to that 9-10% type rate of return. But if I'm taking a distribution like they're talking about, whether it's at the beginning of the year, end of the year, $8,333 a month for the entire year, I'm not going to make that work. It's not, even in years where it's positive, even in years where we've done 10%, not every month is positive. And if I'm taking money out when it's negative, it's a problem.
It's always a problem because as soon as you zoom in, this is where you have to be very, very careful.
Be careful what you read and what you think you can get away with.
Well, exactly. And I see...
And that's a reputable place.
You're talking about
BTN,
the
research.
BTN. Well, I mean, they're good with the numbers. They can give us numbers.
But numbers don't tell you the whole truth about what's happening in reality.
What was it? Three things: lies, damn lies, and statistics. Was that Twain or Buffett or John Wayne or somebody?
All of them.
I don't know who it was. But this is absolutely true. You can get the numbers to say pretty much anything that you want. So what we hear quite a lot is the old, and we've talked about it many times, the old 4% rule, guideline, that says that if you have a certain amount of money and you take no more than about 4%, plus
of the beginning balance.
Of the beginning balance, plus they will give you a little bump up for inflation.
Every year.
Then your portfolio has a 90-some, statistically.
Yeah, mid-90s.
A 90-something% chance that it will survive at least 30 years. Is that how it goes?
Yes, and that's basically either a 50-50 or 60-40 stock bond blend, rebalanced every year to maintain that balance through the entire time.
So in other words, I have $1 million just to make it easy. I can. I've got 60% stocks, I guess.
I don't know which way it goes, but let's go with the 50-50 because that one I know which way it goes.
50-50 is fine. So let's say I have 50% stock, 50% bond, trying to keep it simple. And it says that I would take $40,000 out after the first year.
Well, 44. I would say even per month, 33 a month.
Oh, you can do it per month in this.
And retirees do take distributions on a monthly basis.
Well, it makes sense. They've got paid their lives generally once a month. So.
And most of our bills are due on a monthly basis.
Sure. Okay, so take that much out per month. And at the end of the year, you look at your balance. You see, well, how much out of 50-50 am I now 55, 45 stock bond, depending on how
stocks
things
go
went?
up and outpace the percentage, or did stocks go down and become an underweighting and then rebalancing it back between the two of them to 50-50?
Yeah. Or did stocks go down 30% and now you're way
underweight? You'd be way underweight in the stocks.
Yeah, you'd be way underweight in stocks.
Which actually might be nice to be able to buy in when it's down. But the other problem was you were taking money out of the whole thing when it was down.
And there, again, is another problem when you're talking about things like this.
That is the biggest problem that retirees face, is taking distributions from assets that are lower in value than they were a week, a month, a year ago, or 2 years ago.
Well, so how is it that somebody could do this research that says 4%. I mean, if
well,
I
their math
follow,
was right.
yeah, but if I follow this and stocks are down 30% one year and then they're down another 10% the next year, and am I selling my bonds to rebalance back to buy stocks? What am I doing?
Well, that's part of the problem. But the problem is, if you ever put yourself in a position where you're selling assets when they're negative on the return, those assets can never recover. Yes, over a 25-year period of time, the S&P did 9.8%, according to the BTN statistic. I believe that stat is very true.
Uh-huh.
That's a buy and hold. So they took a buy and hold statistic and turned it into a distribution statistic. That doesn't work. And so if you buy and hold it, and that's another issue when you're looking at mutual funds or other things. Well, over the past 10 years, it's averaged X. So I should be able to, rely on. But those are always buy and hold statistics.
Well,
don't count the distributions.
If I have a portfolio and I have a bad year, like 2000, it was down
2001 to 2, 2008 to 9.
2008, and I had a 50-50 mix of stocks and bonds. I assume I'm selling half of my stocks and half of my bonds in order to, is that how that works? In order to
I don't know whether
fund myself?
I don't know whether they rebalance monthly, quarterly, annually, but they were rebalancing at least annually.
Yeah, so somewhere along that line, if I follow that logic, I'm selling stocks when they're down. Is that correct?
Probably not with stocks because if I'm 50-50 to start with,
yeah,
and let's say that the bonds held even, they just were right there, and I took my 40,000 out of each side, so I took 20 out of each side because 50-50 mix.
Yes,
and the stocks went down. That means they went down, so they're going to be the lighter weight. So to rebalance to 50-50, I would actually be selling my bonds and buying into the stocks to bring them back up because the bonds or the stocks lost more than the bonds did, or maybe the bonds even earned some money back at that time. So I'm actually selling something, the lesser down asset, to buy into the more down asset. But still, everything at that point, now I'm still trying to take that 4% plus my cost of living adjustment out of a portfolio that is down some amount of money. So I'm no longer taking a 4, I'm taking a higher than 4% distribution. If you look at the 2008, 2009 downturn, the average balance portfolio, which would be they're anywhere from 50-50, 60-40, 40-60, somewhere in there. The average balance portfolio was down 25%. So if we're looking at, even if I rebalance, I started with, $1 million, I took my 40,000 out, and then I went down 25%. So I'm down around $710,000,
mm-hmm.
and I want to take my 40,000 plus inflation out of that. That distribution's now in the 7, 8, 9% range. And so at some point, depending upon what happens, unless we have a significant snapback like we saw in 2020, which is very unusual, it takes a while for the markets to bottom and recover. And so I'm going to be selling things when it's down for a while.
So if I retired in 2007, 2008, 2009, and those first few years were really not so good for me, and I needed to take that $40,000 a year out of my $1 million portfolio, aren't I running a really big risk that my funds are going to run out well before 30 years?
Well, study after study after study talks about how the returns that you achieve just before and just after retirement, a couple of years before, a couple of years after retirement, 5 years, 6 years, 7 years, has a huge impact on the longevity of your portfolio going forward.
Mm-hmm.
So if you have and there was a huge difference between somebody who retired in 2007 and somebody who retired in middle of 2009. Because middle of 2009, we were just starting the recovery. So if I had enough money in the beginning of middle of 2009 to have a 4% distribution and let it run, I ended up with that money a couple of years later. If I started that same distribution in 2007, I was a little suspect, and I probably did something stupid like selling out to protect myself, and when the market was down like it was.
Well, yeah. So this goes counter to the, I guess, soothing notion that I say, well, no matter when I retire, if I take 4 or 5% out of my portfolio and increase it every year for inflation, I've got a 95-something% chance that it's going to work. I feel comfortable. But if you retired in 2007, 2008, 2009, and you started taking those systematic withdrawal distributions and rebalanced every year, as I assume this is what they were talking about, I honestly believe I could be out of money at some point.
And whether you actually
well before 30 years.
And whether that's the problem. The emotional aspect of when it's down, that's when we start making decisions and we change our strategy midstream and we start selling off to become more conservative to protect what we have left. So I mean, if you're going to deal with it and just say, well, if it runs out when I'm 96, it runs out when I'm 96. But the problem is we don't do it that way. When the markets are down, when we're relying on our portfolio and the markets are down, 20%, 25%, it's hard not to react. It's hard not to say, well, I need to be more conservative to protect what I have left. I don't want to lose it all. And we tend to, human nature is we tend to become more conservative at the wrong time.
Well,
now,
we did
4% is not necessarily a bad thing. It's just that there may be ways to make it work better for you. We use the idea of the 4% distribution from a very high level planning perspective all the time.
Oh, of course.
The implementation of it, we don't agree with the idea that you just use a balanced portfolio, set it and forget it and never pay attention to it going on. So there's the application of the strategy, and there's the planning, the high-level planning aspect. Yes, I mean, if you are looking at it saying, you know what, I'm thinking about retiring, I've got $1 million. We use $1 million because it's really nice round number. It's easy for math, okay?
Yeah.
And I need $60,000 a year, $70,000 a year. Well, that's not 4%. That's 6 to 7%. Is that going to be a sustainable event? Now you have to dig a little bit different into your idea. Well, in 5 years, my mortgage is going to be paid off. In 3 years, my pension kicks in. And in 2 or 3 more years, my spouse's Social Security kicks in. So my 6-7% distribution today drops. I was dealing with somebody a week or two ago. They had an 8 or 9% distribution right now, if they wanted to retire right now, which they are trying to determine whether they really want to do this.
Sure.
But the 8 or 9% distribution didn't last forever. They're only 60. Actually, they're only 58. So they've got a couple more years before Social Security kicks in. They've also got a hobby that they have right now that's an expensive hobby that's only going to last for another 7 or 8 years. And then the distribution is going to drop dramatically. Yes, they're going to spend a big chunk of their portfolio over the next 5, 6, 7 years. And they have some longevity. But once they get to age 70 and they're no longer doing the hobby, both of their Social Securities have kicked in and their pensions have kicked in. They're not going to need hardly anything.
So in other words, their guaranteed income
at some point in the future
will take over.
It's a combination of a much more guaranteed income than now, which is 0, and expenses being cut by basically half.
Now, didn't we do, and we were talking about this is what we call sequence of returns risk.
But we talk about it a lot because it's a big impact, has a big impact on your retirement.
Now, didn't we have a chart somewhere that we used for a long, long time that showed somebody who had retired in 1969 was taking a 5% distribution out of their portfolio?
And it was a 50-50 balanced portfolio.
Right. And they ran out of money after, I think, about 18, 19 years.
And it was a 5% distribution, but no cost of living adjustment.
Right. So 5% works in that. But what happened to their 95% chance of not running out of money?
Well, they had the 5%. They were the 5% chance. They ran out of money.
Well, yeah, exactly. So, I mean, you would think 95% is pretty good, but it doesn't always work because they didn't have the right strategy.
I think their last name was Murphy.
Well, you talk about that, but
Murphy's Law.
It's true. It's true. I mean, we're talking about this now because markets are down. We don't know, is this going to be the start of something not real good for the next couple of years? Are people who retired on January 1st really going to be in trouble if they're doing this? They very well could be if they don't have some kind of strategy that anticipates this whole idea of sequence of returns, Professor Plum, or they don't have more guaranteed income coming in somewhere down the line.
Right, or their expenses go down the line. And I don't mean you change your lifestyle because the market's down. That's not the change in expenses that I deal with. Mortgage being paid off, your kids are out of school, whatever. There's an expense that goes away that you're glad that it goes away, not the fact that my portfolio went down by 25%, therefore I'm going to have to cut my income by 25%.
We don't want that.
And
we don't want that. So 4 to 5%, Professor Plum, though, can work.
Oh, 4% is a realistic number. I mean, and depending upon your age. Now, if you're retiring at 50, I'd probably want to be a little less than that because now you don't have a 30-year time horizon. You've got maybe a 40-plus year time horizon.
Sure.
On the other side, if you're working and you finally decided to retire at age 75, 80, hey, you could go higher than 4% because it's very unlikely that you're going to need.
Yeah.
I mean, where's the probability that you run out of money or unfortunately you run out of time in the next 30 years? You're going to make it to 115 if you're 80 years old? I mean,
well, but what this shows that even if you're taking out 4 or 5% per year, Professor, if you just happen to retire at the wrong time,
you better have a strategy that is bigger than that.
Yes, and that's where I'm kind of headed with this, because if you don't anticipate years like so far 2022, if you don't anticipate years like 2000, 2001, 2008, 7, 8, 9,
72, 73, I mean,
any of those.
It's very hard to go back very many, and not find a very detrimental time in the stock market.
Well, that's it. I mean, just think of the people. I don't know any personally, but I'm not on that part of it. Maybe you've seen people who retired January 1st of this year, and their stocks had gone up for the last 12 years.
They've been doing real well.
They've been doing very, very well. And, I've suddenly got enough money, and boom, their stock portfolio has taken a 20% hit or whatever.
Well, now, hopefully those people that have retired last year or beginning of this year set up a strategy that allowed them a buffer zone, what we call bucket number one, a safer area, a low volatility area, a high liquid area where I can draw down the cash flow I need while the stock markets go through the inevitable downturns and hopefully the recovery, which we've always had in history, so that we don't have to sell anything when it's down. That's the approach that we want to take, so that we're not selling in the market right now thinking, oh my gosh, I'm going to have to change my life around. So having an appropriate strategy at that point. Now, what happens is, what if somebody was looking to retire now, mid-year, and at the end of last year, they're looking at their portfolio saying, oh my gosh, life is going so well. The market is doing so well. Everything looks rosy. I'm going to stay with my, foot to the pedal. I'm going to keep going for the growth because I have enough to retire right now, but I want to get a little bit more buffer zone. I want to have a little more comfort feeling. So I want
more money.
I want more. And it's, the world is great, right? And now they're looking at it saying, well, not only do I not have the buffer that I was hoping to build over the next 6 months to a year, I don't have enough money to really, my $1 million is now, 820,
whatever.
So my 4% is, it's a little higher now, and I'm feeling really uneasy about the direction and what's happening with the economy and things of that nature. Maybe I can't retire when I thought I was going to retire. I 6 months ago, I thought I could retire. Doing the math, I could retire. Today, with the market down wherever it's down, I don't feel comfortable about retiring. So I let the market decide when I was going to retire because I stayed gung-ho. In this
example.
Yeah. That is not a good strategy. When you have the ability to retire, where they were 6 months ago in this example, they should have set themselves up to retire at that time, knowing that the next 6 months is only going to be gravy for them.
So how do you do that? Explain what they
bucketize ahead of time.
They had their $1 million on December 31st, let's say, of 2021, and they could have retired. They wanted to put the pedal to the metal and the thing to the floor and get maybe $1.1 million or whatever it is that they thought. But they found out after 6 months that not only did they not have the $1.1 million, they had 800-something thousand, and they were doubting. So what you would have done if you were this...
You bucketize it as if you were retiring at that point. They probably went too long. You really should be looking at bucketizing, time segmenting your money, creating that buffer zone of 4, 5, 6 years before you actually retire.
Oh, really?
Yeah, John.
I kept putting it off, which is what people do.
Yeah, because as long as things are going well, nobody wants to stop. And in the first couple of months, it's not going to be it's just a little pullback. We've seen these before. Well, it's a little bit bigger of a pullback. And how big of a pullback is this really going to be?
So
I don't know.
If you bucketize, as we've sort of been saying over the last 3 or 4 podcasts,
for the last 100 podcasts, probably.
Well, but as we're kind of pounding into people's heads here, since the markets tend to be on people's minds, and can they retire tends to be on people's minds. how much can you? If you bucketize, you're still potentially taking 4 to 5% out
of the beginning value. Yes.
Yes, but you're taking it from an account
that didn't lose any money, or maybe only had a 1% or 2% down instead of a 15, 20% down.
Yeah, depending on what you need. Now, 4%. Do you have to take an increase for inflation every single year? I mean,
people don't.
It's usually what
this
you hear
year
is
they
that,
might.
right. Well, they usually say 2.5% on average over the years.
Well, it used to be a lot higher than that on average, except for the last decade we've had very low inflation, so we've brought those numbers down a little bit.
Oh, the last 15 to 20 years we've had no inflation. Sure.
Yeah. Do you need to? You don't. What I've experienced. Now, I have not done any extensive studies with millions of retirees, just the ones I've talked to for the last 30 years.
Yeah.
They typically don't adjust every year
for inflation.
Sometimes they go several years without adjusting. Sometimes they adjust twice in a year. Like maybe this year happens to be like that because inflation, for whatever their reason, the spending they're doing got more expensive. Mm-hmm. I've also seen people in their early retirement adjust their spending more often than people later in retirement. Mm-hmm. And for that matter, the people later in retirement, when they do the adjustments, they adjust down on their spending, not up.
Well, that's where I was going to go, because if you're spending a certain amount when you're age 65, 66, 67, well, are you going to be spending that same amount plus inflation? Are you going to be spending 20% more than that when you're 85, 86, 87?
I mean, yes, inflation does affect what you're buying. But what we have noticed, what I have seen through working with people for 30 plus years, is that they're not buying as many whatever units of whatever it is.
Oh,
whether
absolutely.
It's clothing, food, whatever. They're
not driving as much. They're probably not.
Unless they were my grandfather, still driving cross country in his motorhome at 94. But that's an unusual circumstance.
For the most part, people
tend to slow down a little bit. Mm-hmm. Not in the early. 65 to 75, they're still going well. 75 to 85 is pretty. They're starting to flatten out and maybe come down a little bit. But from 85 to 95, their spending comes down. And I know that they're going to say, "What about healthcare?" For most of the people, the huge healthcare costs that we experience are in the last couple unfortunate years.
Well, that's true. That's true, and you've seen that as a statistic. Do you see people? Are they able to take maybe more out early and less out when they're 85?
People don't like to plan that way. They like to see that they're going to have more than enough money. But yes, I have seen people plan that way, and they will, by hook, crook, or whatever, they tend to, when they get in their 80s and older, start slowing down and not spending as much.
Well, you did talk about, if the mortgage is paid off at age 70, that's an expense that goes down. So
your expense,
you may be able to take more.
These people I was talking to the other week,
if the hobby goes away.
The hobby's going to go away because at some point they're going to be too old for this particular hobby physically.
Sure, or they're not going to travel as much, or you got some other form of pension that kicks in, or social security, whatever it is, where maybe some extra guaranteed income comes in. Those are reasons that you may be able to take more out early.
Oh, very much so. I mean, the mortgage is a big one. More people are entering retirement with mortgages than in historical terms. But and some of them, it's a matter of, this thing's never going to be paid off. Unfortunately, I've seen this digression, but people what's happening for a little while, maybe not right now, but they get up 60, 62, 63, and they refinance to a 15-year mortgage to try to get it paid off quicker, but they're going to retire at 65, 68.
Oh, wow.
That, to me, doesn't make a lot of sense because they just jacked up their expenses. And so at 65, 70, instead of refinancing to a shorter-term mortgage at that point, when you become, on fixed income, so to speak,
oh man,
go to a 50-year mortgage if they'll give you one. Get the payment down as low as possible, because is it really going to matter that it's paid off when you're 85?
Well, it's, again, a psychological factor that says,
but
why would you retire with a mortgage?
Making that payment becomes difficult when you're relying on your portfolio to draw that income.
Well, and again, this goes back to how much can you take out of your portfolio? I mean, would you say on average 4 to 5% is a decent number to start with, long as
if it's going to be consistent throughout your retirement,
and as long as you have the right strategy in place and you're not selling your stocks.
You're not ever
fund
putting
that.
yourself in a position where you're selling when the market's down.
So it's
selling
not-
the market when it's down.
So it's not so much whether you're taking 4%, 5, 6, 7, even 8, depending on
well, you got
circumstances.
8's going to require a distribution or a reduction in payment at some point.
Yeah, and probably sooner rather than later, I would hope. But let's say 4, 5, 6%. You're as long as the strategy is in place to deal with things like sequence of returns risk, it's you're much better off.
Well, earlier you referenced a study that John Hancock did about somebody who retired in '69 with $100,000 and took 5% a year out, and they rebalanced every year back to 50-50, and that person was out of money in just over 19 years.
Yeah.
So they didn't quite make the 20-year mark. And contrast that with somebody who retired 10 years later, 1979, did exactly the same thing, $100,000, 5% distribution, no cost of living inflations, and 20 years later they had $500,000.
Yeah.
I went back and played around. They gave me all the numbers and played around with it, and it said take that $100,000 and do a very, very simple bucket. Put half of it in your pillow. So you took the $100,000, you left half of it invested in that same balanced portfolio. You got the exact same returns in the balanced portfolio that the full 100 did before.
But you got 50,000
sitting in a pillow or my cookie jar or whatever. And each year I take my $5,000 out, 10% or 5% of 100,000.
You're earning nothing, but
I'm earning nothing. Now back in 19, we could have earned something in cash, but
let's ignore
I didn't
that.
want to do that math.
Yeah.
I was lazy. So I just took 5,000. So I know that I've got 5 years, $5,000 a year for 10 years. And then my cookie jar is empty. So but I left the balanced portfolio alone. And I rebalanced it. I just didn't take any distributions from it.
All right. So you now have 50,000 in this ad example working for you over 10 years.
And then 10 years from now, I took 50,000 out of that and put it in the cookie jar and gave myself another.
Well, how much was in the portfolio after 10 years you had enough to refill the cookie jar?
I did. I had more than $50,000.
No.
I don't remember the exact number.
All right, but it was all right.
But I do remember the number at the end of 20 years.
Yeah.
Where in the first example, where I used the investment that had the better rate of return for the entire thing, I should say the better potential rate of return, that had averaged better than I needed for all those years. The guy that was empty at the 20-year mark by using the entire portfolio, by using the 50%, by bucketizing it, I had $107,000 left over. Okay, I started with 100. And I only ended up with 107 20 years later.
But you weren't out of money.
Right. I'm about $107,000 better off in this case. And so I figured that made some sense. Now, on the other side, the other person who started in
1979, yes.
Did just the portfolio, had, 500,000, give or take. I can't remember the exact number. But I said, well, what would it have done to that person
if you bucketized that?
So I did the same thing. I put 50,000 into and just took the 5,000 a year for 10 years, took 50,000 out 10 years later, the rest in the portfolio, and it did affect the overall, rate of return.
You didn't do nearly as well.
But I didn't do as after 30 years, the person that died the person that started in 1979 into the favorable market, they had about $600 and some thousand, low 600s. The person that started at 1966 that only had 100,000 left, or 69 that had 100,000 20 years later, at the 30-year mark, they had like 500,000. It was a little over.
If you bucketize it,
it was a little over $100,000 give up on the good side.
Is that if you bucketize it?
If I bucketized, if they bucketized, so the give up wasn't nearly as big as I expected. But
you would expect if you bucketize your portfolio, which means you're taking some of the decent chunk out of the stock market growth potential, and you're putting it into something that's far less volatile, and by the way, earns far less. You would think that would have a big effect on that portfolio's performance after 30 years. But what you're saying is it had an effect
in that 30-year period of time.
Yeah.
It now the 30 years for the person that retired in 69 ended in 99. So their last 10 years was gangbusters.
But the other one ended in 2009,
which was not so good on that last decade.
No.
So that's why they started to even out. There was a much bigger disparity. If you look at the 20-year mark, there was a bigger disparity, because of the time horizon involved. But over time, things happen, for good, bad, or indifferent. But I was surprised that it didn't have as big an effect. Now, does that mean it's always going to work perfectly? And there is nothing that will solve everything that this world can throw at us. But so far, it's worked better every time I've played with it, except for when the market's up, 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 up. When the market's always up, like we saw through the 90s, almost any plan would work.
But you don't bucketize for rate of return.
Well, and you don't bucketize for the better times. You bucketize for the problematic bad days.
Something to fall back on.
Yes.
When the markets are down 17% year to date, or the markets are down 37% like they were in 2008.
Right. You bucketize to protect against the bad times. Because the reality is, if we knew for a fact that the next 10 years were going to be like the 90s, if we knew for a fact that it was going to average, or not average, but have a better than 10, 15% rate of return every year, 5, 6, 7 years in a row, we wouldn't bucketize. But you don't know that. And even when you get a good feeling for it, we saw, the latter part of 2015 to 21, I should say. 20 had a hiccup, but it recovered so fast people forgotten about it. 2018 had a bad market towards the end of the year. We've forgotten about that one because it kept, the attitude was still, things are going up, things are going up, things are going up. People loved being invested. People loved investing in their 401k in November, December of last year.
When things were way high and very expensive.
Which was, and now they don't like investing in the market. When it's, almost 20% lower, they were happy to pay 20% higher than today's price, and they don't like paying today's price.
And we're seeing this in the stock market.
We're seeing it all over.
Today.
Now is the time to be an investor.
So just to answer the question, how much should you withdraw from your portfolio?
Depends on you. Let's talk about how your needs are going to be. Do you have additional income coming in later on? Do you have expenses that are going to fall off later on? Otherwise, from a very high level, stick around that 4 or 5% rule.
There you go. There you go. You heard it here from Professor Rick Plum. He is the certified financial planner professional.
And do it with a good strategy.
Well, that's the whole point. I mean, that's it. Don't just do this systematic withdrawal thing that's easy, but could really run you out of money if you retire at the quote-unquote wrong time.
Yes, I mean, in great times, almost anything works. We're not doing this for great times. We're doing this for reality.
Yes.
Because stuff happens.
And people do not like to lose money. It hurts.
And we get emotional, and we do silly things like selling out everything so we don't lose it all just about the time it gets to the bottom. I don't know when the bottom is, but it's happened before.
But what you found is if people have enough income to get by, enough income to pay their bills, they can ignore the noise.
They can ignore it a lot better.
A lot better. They may not completely. If you want to talk more about this with Professor Rick Plum, certified financial planner professional, CFP professional, at Lucia Capital Group, 800-644-1150. That's the number, of course, 800-644-1150. They do this all the time. You do this every single day, Professor Plum, with clients, with potential clients, with people who just want to know, hey, you know what? I thought I could retire at the end of last year. Now I'm getting really nervous. What do I do? You may still be able to retire. You may still be able to work it out, but you got to have a strategy. You got to have somebody who looks at it and says, yep, we can make it work. Or we got to make some adjustments. And that's what these folks do at Lucia Capital Group. And as I said, they do it every single day. 800-644-1150. Go online, luciacap.com, LUCIACAP.com. Lots of blog posts there, videos, Lucia Capital Group weekly videos, a ton of reference material, things. If you just want to learn about it, check them out at luciacap.com. Also, our podcast is at Spotify. You can download the podcast, be a subscriber. We got so many people. You can also tune in anytime you like. We're talking about doing webinars again in our new studios. We will let you know more about that on this podcast. But if you want more in-depth discussions of things like buckets, like retirement, like Social Security, tax planning strategies, we'll have those coming up as well. Just keep it right here on our podcast. My thanks to Professor Rick Plum. We'll talk to you. That was a pretty good episode 100. Not bad.
Well, it goes about what we are all about, buckets.
That's what we are. We thank you for listening, and we will talk to you again. For Professor Rick Plum, I'm Johnny Dean, podcast host. Talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. The S&P 500 index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk, interest rate risk, bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall, financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.